Good morning. My name is Jeff Stauffer, Community Relations Director with Elville and Associates, and welcome to our Advisors Forum today, a discussion regarding the pending Biden-era tax law changes, understanding the ongoing discussion, the 99.5% Act, the Van Hollen Step Act, and the American Families Plan. So how this will work today, if you're new to our webinars, if you are, welcome. We're glad you're here. You as the attendee are in listen-only mode. However, if you have questions, please pose them throughout the presentation, and I, as the moderator, will work with Steve to pause periodically to answer them, as well as leave time for questions at the end. You also received the presentation by email from me for your convenience yesterday to take notes on it if you wish. So if you did not receive the presentation for some reason, it is available in the handout section of your dashboard to download at this time. Everyone will also receive a post-webinar feedback survey right after the presentation, and we ask that you please just take a couple minutes to fill out this simple survey to offer us your valuable feedback about the presentation. We read every comment and appreciate you filling this out. Also, for certified financial planners, CPAs, and other professionals on today's webinar, you may receive 1.5 continuing education hours for attending. So if I do not have it already, for my records and per the requirements of the CFP Board of Standards, please email me your board ID number. And specifically for CFPs, I also need the last 4 digits of your social security number as soon as possible. I'll also be sending out certificates for CPAs and other professionals soon after today's presentation. So as a reminder, virtually all of our webinars in our Elville webinar series are available for CE hours, not just the Advisors Forum. So we welcome you to attend our other presentations as well. So we have many advisors on today's webinar, of course, and we also have some clients as well who express interest in attending. So we're glad everyone is here. So most everyone knows Steve and the firm, but for those who don't, I'd still like to share a brief introduction for you about Steve and the firm. So I'm going to do that right now, and hopefully everybody can see my screen here. So Elville and Associates, we were founded in 2010 in Columbia by managing principal and lead attorney Stephen Elville. We have a number of different practice areas here at the firm. We work in estate planning and special needs planning, elder law and elder care planning, estate and trust administration, business law and succession planning, guardianship and litigation, and tax planning and asset protection. We have 7 attorneys, 12 staff members, and 5 locations. Steve and I are coming to you live from the Columbia Gateway Community location here right now. And our mission, as it always has been and always will be, is to provide practical solutions to our clients' needs through counseling, education, and the use of superior legal technical knowledge. And we do offer a lot of education here at the firm. We do that through our planning processes with our clients. We offer well over 100 educational webinars and workshops in the communities that we serve each year, and also by way of our accredited client care program. We are one of only 2 firms in Maryland to have a client care program, or CCP as we call it here, accredited by the Client Care Academy in Boston. It's a very robust program that offers a lot of additional benefits for being with the firm, having a relationship with us that a lot of our clients take advantage of. So if you're interested in learning more, let me know, and I'll be glad to share some more information about it with you. A little bit about Steve. So Steve's work as an attorney for the past 20+ years has been centered in elder law, special needs planning, and estate planning, with an emphasis in the areas of tax planning and asset protection. He's a member of many different professional organizations, including the National Academy of Elder Law Attorneys, the Academy of Special Needs Planners, and the National Network of Estate Planning Attorneys. A very unique way to approach working with clients. He works to bring peace of mind to clients by creating solutions to their needs through counseling, client education, and the use of leading-edge legal technical knowledge. He is a seasoned speaker. Every year presents at many webinars, workshops for businesses and their employees, conferences, and continuing education events. I'm also very pleased to announce Steve was named to the Maryland Super Lawyers list for a 6th time in 2021 and a 5th consecutive year, and also had a feature story written about him in the National Super Lawyers magazine about the Elville Center for the Creative Arts, our firm's charitable organization that he founded in 2014. If you're interested in learning more about that, let me know. I'm the executive director, which I'm very proud to be, of the Elville Center. And if you'd like to learn more about that, let me know. And I'll be very happy to share the work that we do at the Elville Center for the Creative Arts. So with all that said, I'm going to go ahead and turn it over to Steve and give Steve the controls. And let me go ahead and do that. Change presenters here. Steve, you should see that button pop up on your end.
I do see it, Jeff. Thank you.
Okay.
And I'm going to get my slideshow started here. And it looks like I may be in control. Very good. Very good. All right. Well, thank you, Jeff. And good morning to everyone.
Let's see here.
Jeff, I believe I do have control.
Yeah, it looks like I can only see about half of your screen.
All right, so let me then go out of this, excuse me. I'll go back to where I was just to get rid of. All right, now that may take care of it. Hang on just a moment.
Not sure if that was just on my end. Just want to be sure. There we go.
How about that, Jeff?
That looks great. Yep.
All right, thank you. All right, well, thank you, Jeff, and good morning, everyone. Thank you. It's a very busy Wednesday, and I am very privileged to be here with you this morning. I thank you for taking the time to visit with us again here for the Advisor Forum. It's a great privilege for me to present not only to you, but alongside of my good friend and colleague, Jeff. And I couldn't put on these webinars and Advisor Forums without Jeff. So Jeff does a wonderful job. He'll be our moderator as we go through. And I will stop occasionally to take questions as we normally do. And we will have question and answer at the end, of course. But again, I want to wish you spring greetings, and I thank you for taking the time to be here today with me. So we are at a critical juncture, and many of you have read some synopsises of this particular situation, or summaries, and you've educated yourself so far. But today, I'm going to try to give you a broad brush education of what I see in our practice and what I read and what we get from our national sources of information about the pending Biden-era tax law changes. I want to try to give you some tools. If you're advisors on this call, I want to give you some tools for your clients. I know we have some clients and others on this call, so I thank you for attending as well. The whole purpose of this presentation is to give you some advance notice of what's happening and to try to give you a sense of urgency about this, because even our national sources of information in our wire houses for what we would call our attorney resources and CPA resources, many of them are wide-eyed at these proposals. And I actually think that we are going to see some significant changes getting ready to occur. So we want to make you aware of what those are. And I want to give you not just the information, but I want to give you some practical steps forward and to let you know that we're here to assist. We don't have all the answers based on a lot of the speculation that you will see that's going on with this particular presentation and this information, but we are trying to give you some practical steps and to be here for you to assist as you think through this for yourselves, if you're a client or other person on the call or an advisor, and what to do for clients. Now, I always try to say, to attempt some form of humor before we get started. So I will say that at some point during this presentation, you may ask yourself, what am I doing here? And what does this really mean? And if you have that epiphany during this presentation, you probably won't be alone, because there are few real answers and a lot of information and honestly a lot of speculation. But I think the thing to take away from this presentation will be something is likely to happen, and it probably will be significant. We just don't know what it will be. We do know that there are congressional committees that have started in the month of May to discuss all of these proposals and possibly others. And we know that probably by the fall of 2021, we will know a whole lot more about the tax changes that are going to occur. So with all that said, let's sit back and get through the information here and the next hour or so that we can have time for questions and answers along with others during the process. All right, so a summary of today's presentation. I'm going to give you a summary of the current state of the U.S. estate, gift, and income taxes pre-Memorial Day 2021, here at the spring of 2021. We're going to talk about the 99.5% Act. We're going to talk about the Van Hollen Act, what was initially thought to be called the Gains at Death Act, but now it's really called the STEP Act. The American Families Plan, which really just was put out by the White House recently. We're going to talk about potential impacts on estate and gift planning, federal and state. We're going to talk about potential planning strategies for 2021 and 2022. We're going to talk about the risks of doing such planning. And then I want to talk to you about some basics, the maintenance and updating of estate plans and maintenance and updating and education with clients in general. I want to talk about the importance of partnership and the advisory team, and we'll describe the advisory team. And then, of course, we're going to talk about questions and answers. So some of you are very familiar with this already, but for your information, here are the 2021 income tax rates that we're dealing with now. And of course, one of the proposals on the table, which is probably a no-brainer to happen, is going back to a highest tax bracket of 39.6%. plus the net investment income tax and so forth. So these first slides here are just for your information for those of you who don't look at these income tax brackets every day. So I won't dwell on that too much. We know the highest rate right now is 37%. And now, where are we in 2021 with the state and gift tax overview? So we're in a situation where we have an $11.7 million per person estate tax exemption. And this is a gift tax exemption too. It's a combined exemption, or $23.4 million per couple. Many of you are aware of this already. Indexed for inflation. So this is slated to continue, indexed for inflation. And then in 2026, this is supposed to go down to 5.5 million. So it's slated to go away regardless of congressional action. It's slated to go away or be reduced or cut in half by 2026. And of course, we have portability. So portability is the ability of a surviving spouse to port or use the deceased spouse's exemption amount, whatever they have not used during their life, to port that. So this has been a tremendous blessing in estate planning to simplify estate tax planning for many people. Now on the state level, we have a $5 million Maryland estate tax exemption. We do have portability, and so that's a wonderful thing on the state level. And we have no gift tax. So Maryland is not such a good state for most tax situations, but the good news is we have no gift tax, and most states do not have any gift tax. So of course, Maryland has an inheritance tax, but that's not the focus of our discussion today. We still have the annual exclusion from gift tax of $15,000 per person per year, and many of you are familiar with that. So that's the state of things. And going back to the first bullet point here, the question we have for wealthier clients is, do we use or lose the exemption amounts that we have, these temporary, if we want to call them that, temporary exemptions that are for couples, 23.4 million for the couple. Do we use it or lose it? Is it going to go away or not? And that's what has caused so much speculation. So I want you to be thinking in terms of, yes, we definitely could lose it by 2022 or sooner, even though the American Families Plan, as we're going to see in a few minutes, President Biden is kind of stepping back from reducing the exemption amounts and seems to be focused on income tax. But the prior proposals, as we're going to see, did discuss a reduction in the estate tax exemption. Getting into that, for the 99.5% Act, and there are many wonderful summaries out there. I'm just going to give you some of the highlights. This was proposed on March 25th, 2021 by Senator Sanders. And this is similar to the 99.8% Act in 2019, which was very little known. And some of these proposals that are in the 99.5% Act are some of the Obama era tax proposals. So the potential impacts here of this act, if it were to carry through into the Biden administration's final proposals, is a reduction in the estate tax exemption to 3.5 million. However, it would still be indexed for inflation and with portability. So that's good, even though it's not good that we would have such a reduction. We would still have portability, and that's a good thing. Now, for those of you who are Maryland residents, which I'm assuming most of you are, will the Maryland state estate tax exemption be reduced? My personal feeling would be absolutely it will go down if the federal exemption goes down. So I would not be surprised whatsoever if the Maryland exemption was reduced to 1 million. So we have to know that Maryland has a state estate tax. It does not follow the federal scheme. It has its own state estate tax. So we have to keep that in mind. The federal estate tax rates would be anywhere from 45% to a maximum of 65% under the Sanders proposal, up from 40%, which is the current rate. And the federal gift tax exemption, we have to remember this now, it would be decoupled, so to speak, from the federal estate tax exemption and would go back to what many of you remember in the early 2000s, which is it was 1 million for federal gift tax purposes. That was the exemption. And it was not indexed for inflation. So we could be looking at, under a worst case scenario, it seems, a $3.5 million federal estate tax exemption with a $1 million federal gift tax exemption. And of course, remember that Maryland has no gift tax. So for those of you who might be wondering, why am I bringing that up a couple of times, is because those of you who may recall 20 years ago or so, 15 or 20 years ago, when the exemption amounts were not as big, the ability to be able to make gifts, the ability to be able to make gifts and get assets out of a person's estate for Maryland estate tax purposes is a powerful tool, and that may be revisited because Maryland has no gift tax. It may be revisited when the exemption amounts come down, if they do. So that's something to keep in mind. We always have to keep in mind when we're making gifts, not just the estate tax element. We have to be concerned about the income tax element of those gifts and triggering capital gain. And we're going to talk about capital gain a little bit here in just a second. But for estate tax purposes, we have some powerful tools for Maryland tax planning because there is no gift tax. Now, the 99.5% Act really takes away a lot of the advantages of grantor trusts. And remember, for those of you who just need a brief refresher on this, what is a grantor trust? Well, a grantor trust, simply put, is a trust where the grantor pays the income tax. A classic example of this is the revocable living trust. The grantor can amend or revoke that trust at any time. It automatically is a grantor trust under the IRS rules, and that trust, that grantor pays the tax just like they always did. Another brief example of that is most irrevocable life insurance trusts are drafted as grantor trusts. The grantor pays the tax. All right, so but there are a lot of advanced planning tools that can be implemented that are grantor trusts. And here we're seeing that there's no cost basis adjustment. So what are we talking about here right from the get-go? The Biden administration, and of course this is the Sanders proposal we're looking at here, but the Biden administration has stated that one of its #1 goals for tax purposes is to eliminate the step-up in basis. Here and we're going to talk about that in a few minutes. Here we're seeing Senator Sanders' proposal saying no cost of basis for trust property, but there are some exceptions. Okay, if the property is included in the grantor's gross estate, then there would be a cost basis adjustment, and certain grantor trusts are grandfathered. So you're going to see that throughout this presentation, grandfathered. So, even if we don't look at the estate tax exemptions and get, too exercised about that, we do need to take seriously this issue of the loss of the step up in basis and should certain trusts be implemented in 2021. Included in the estate of the grantor, lifetime distributions would be considered gifts. Assets deemed gifted if the grantor trust is toggled off. So some of these things are advanced strategies, but the point here is that the Sanders proposal would propose to seriously limit the advantages of grantor trusts. And again, existing grantor trusts would be grandfathered. So let's just talk about something simple here. And I apologize that the irrevocable life insurance trust is listed twice here. That should not be the case. So let's talk about grandfathering ILETs. So let's say you have a client that wants to implement or should implement a life insurance trust and they're sitting on the fence about it. What we need to be thinking about is implementing these kinds of grantor trusts in 2021. For example, if the Sanders proposal were to get more traction, there would be problems with funding ILETs after 2022. Not only would the rules potentially change for grantor trusts in general, but how we fund an ILET, for example, using annual exclusion gifts, those are proposed to be changed as well. So we want to be thinking in terms of, in 2021, of, are there grantor trust strategies that need to be implemented, and perhaps they should be accelerated and not waiting until 2022. Under the Sanders proposal, valuation discounts, being able to discount the value of property or a business by lack of marketability or minority interest discounts, these would be severely limited or eliminated. So I won't get into the details of this, but here are some bullet points about the valuation discount rules and how Senator Sanders' proposal would attempt to severely curb those, okay? So if we have valuation discount planning to do, we want to be thinking about doing it in 2021, subject to the further information here in the presentation. Grantor retained annuity trusts, these are not magic bullets, so to speak, to do estate tax planning in a lump sum kind of way, but it is a very powerful tool for certain clients. The Sanders proposal would effectively eliminate the viability of using the grantor retained annuity trust. So this is a tool in the toolbox for many estate planners and for wealthier clients. And if these proposals were to get traction, this would be severely curbed. Dynastical trusts would be curbed. Now, what I mean by that, dynastical trusts are in Maryland not subject to the rule against perpetuities. They can last forever, but Senator Sanders' proposal would seem to limit the tax advantages, meaning the generation skipping tax advantages of a dynasty trust, and limit it to only 50 years. So this is a bit disappointing for a lot of folks who want to leave assets in perpetuity and be able to avoid the generation skipping tax. And for those of you who are not familiar with that, that is a very onerous tax that Uncle Sam attributes to certain trusts and certain skips in generations. So this proposal would seem to limit that as well. Under the Obama proposal, it was proposed that after 90 years, these generation skipping tax advantages would go away. So this is a very significant proposal from Senator Sanders. We have to be aware. Exclusion from annual gift tax. Right now, of course, we know it's $15,000 per year per person. Annual tax-free gifts would be limited under the Sanders Act to $10,000 per donee. There should be another E there on the end of that, not done. Per donee, D-O-N-E-E. Annual tax-free gifts would be limited to $20,000 per donor. So these are significant limitations. And if there was a contribution in trust, it would be limited to $30,000 per year. So as I mentioned earlier, this could affect irrevocable life insurance trust planning and other funding techniques after 2021. So when we saw this Sanders proposal, it sent shockwaves, and I'm sure it did through your community as well. It sent shockwaves through the estate planning community, and thank goodness this has been dampened a little bit. The shockwave has been dampened a little bit by the further proposals. Now, the step up in basis, there have been several discussions leading up into the American Families Plan on April 28th, which we're going to talk about. And one of them was Senator Wyden's proposal, which was called the mark to market, which to my understanding meant that capital gains were paid every year. And that was one issue. Carryover basis, no step up in basis, okay? And the Van Hollen Step Act, and we're going to talk about that in just a second, capital gain would be realized at death, to my knowledge, very similar to the Canadian system. So this is, these are the most radical proposals we've ever seen, and I'm guessing 50 or 60 years in estate and income tax as it relates to estate planning. Now let's talk about the Van Hollen Gains at Death Act, or the Sensible Taxation and Equity Promotion Act. And this was proposed right after Senator Sanders' proposal. And this is a new proposed Internal Revenue Code 1261 if it were to get traction. Now, what are the impacts of this? Common transfers of assets would be subject to capital gain. Things that we normally think about, transfers on death and so forth, would now be subject to capital gain. There would no longer be a step up in basis. Transfer by gift. So let's talk about gifting during lifetime. Certain gifts to individuals would not be affected. So gifts to spouses, generally no. Gifts to others, generally yes. There would be capital gain on those gifts. Gifts to charities, no. Gifts to non-grantor trusts. Gifts to non-grantor trusts. Trusts that pay their own taxes, yes, there would be capital gains on those. And notice this, there would be further triggers on tax on capital gain every 21 years. And to grantor trust, what if we have a lifetime gift to a grantor trust? We talked about that just a minute ago. The grantor trust is a trust where the grantor pays the tax. It depends on whether there is going to be estate inclusion, that grantor trust is included in the estate of the grantor, or or estate tax exclusion. The gift is not considered to be part of the grantor's estate. It's been a completed gift. So this is the Van Hollen basics of that STEP Act. Now let's talk about transfers at death. We talked about transfers during life. Transfers to individuals such as spouses, no capital gain. Transfers to others at death, yes, there would be. Transfers to charity, no, so that's consistent with the lifetime transfers. Transfers to grantor trusts, this is going to depend on who the beneficiary is. So let's say that a spouse passes away and leaves an asset to a Q-tip trust, or what is called a marital trust. There would be no capital gain there, so that's good. But transfers to other types of trusts, like a credit shelter or a bypass trust, it looks like the answer would be yes. So we've talked about the Sanders 99.5% Act and the Van Hollen Act. And I apologize, it looks like we have a few more things to talk about the Van Hollen Act. But there are certain exclusions. So this, so far, is very, very dire, all of this information so far. It's all not good in the sense of what we're used to. And we know that our country has gone through a lot of civil unrest. We have trillions of dollars of stimulus. There's lots of discussion about rebuilding infrastructure. There's a lot of polarization on Capitol Hill, all very, very negative in many ways, including everything I've just discussed. But here are a few bright spots. Even if the Van Hollen Act gets traction, he's proposing a $1 million exclusion from capital gain, so that's good. Charitable donations are excluded. There would be an exclusion that continues $500,000 on a personal residence, and other miscellaneous exclusions, which we don't have time to get into today. And income tax paid would be deductible against estate tax. So that's another bright spot. So yes, very dire predictions about the loss of the step up in basis, but as we're going to see, a $1 million exclusion being proposed by Senator Van Hollen and those other folks that sponsored that bill. And then we're going to see even more aggressive exclusions being proposed by President Biden. Jeff, I'm going to keep going through the American Families Plan real quickly, and then we can take any questions that people may have before we continue. The American Families Plan, so this is kind of the third leg on our trip through this material, was released by the White House on April 28th. So we were reeling from the Senator Sanders Act. Somebody was joking that Senator Sanders wants to give everyone $1.29 of estate tax exemption. So you have to try to find some humor in that. Then we were reeling from the Van Hollen Step Act. And then a month later, we see the American Families Plan released by the White House. And I should say at the outset, this is still a work in progress. So this represents President Biden's administration's 2021 tax proposal. Potential impacts, of course, will include estate and gift tax changes. I should say may include estate and gift tax changes. There is discussion, as you may have read, that the administration will not touch the estate and gift tax exemptions. So that would be a complete turnaround from what we've seen with the two other proposals. There would be individual income tax changes, including capital gains. And I will say here that I read in one of the summaries I've read that Janet Yellen says that her main goal or the main priority is to eliminate the step up in basis. So again, you hear that drum beating that folks are going to be facing a loss of a step up in basis. Corporate tax changes are going to be on the horizon. Most of you are aware of that. There's going to be income tax increases for individuals. There's going to be corporate tax increases. We anticipate that this is going to be passed by the fall of 2021. No one really knows, but the proposed start date would be January 1st, 2022. Now, I want to go backwards for just a second. Many of the provisions in the Van Hollen Act, to my knowledge, would be retroactive back to January 1st, 2021. So that's going to be a red flag for us to continue to think about. What if clients take certain actions in 2021 in good faith that they're getting ahead of these new laws? We have to be aware that what if the actions we take either will be null and void for purposes of avoiding the problems that we're facing here because it was retroactive to 2021, or what if we have retroactivity that will affect gifts that people make in 2021 that could actually affect that person by triggering gift tax. So we have to keep those things in mind as much as we want to plan to get ahead of the changes. My understanding is that President Biden's Green Book proposals are continuing to evolve. The changes from the Green Book, so to speak, are expected to continue to be implemented into his American Families Plan. So the estate and gift tax exemption decreases, according to the latest we've seen about the American Families Plan, are on hold for now, but the discussion continues. My conversations with attorneys who practice nationally in various states say that suggest that those attorneys seem to think that we should continue with aggressive planning on the assumption that this discussion of estate and gift tax exemption being on hold for now is just a temporary thing, and of course to plan with precautions and tools that can help undo gifts that could create taxes if there is retroactivity. In other words, we should continue to assume that big changes are going to come based on everything that we see, but for now it seems to be on hold about the estate and gift tax exemption decreases. Portability is expected to continue. So that's really wonderful thing between spouses. There will be an emphasis on capital gains. I'm repeating myself on that on purpose. The elimination of the step up in basis is a priority for the Biden administration. Now, here is the good news about the American Families Plan. Capital gains payable at death, there would be a $1 million exemption per individual, according to the Biden plan, $2.5 million exemption per couple. So, that is a significant exclusion or exemption. So we should be very happy about that if the step up in basis is eliminated. Now, further proposals, and I'm giving you a very broad summary here. Previously, of course, the Tax Cuts and Jobs Act had limited the SALT deduction, and the Biden administration plans to bring that back. The state and local income tax deduction would be brought back at full-fledged, to my knowledge. There would be an increase of top tax rate, as we discussed earlier, of 39.6% from the current 37%. Increases in the corporate tax rates from 21% to 28%. Increases in capital gains rates, of course, to 43.4% or higher. All right, these are big changes, not applicable to gifts to charity, okay? And of course, the American Families Plan limits, without me getting into all the details, limits the annual exclusion for gift tax in similar ways to the other two acts that I just discussed. It also encourages family-run businesses to remain family-owned. So there are certain incentives there to keep businesses within families to avoid capital gain. All right, so Jeff, that is a lot of information. Most of it is mind-numbing. Most of it is rather discouraging about the changes that are coming potentially. I'm going to just stop for a second and see if anyone has any questions.
Thank you, Steve. We do have a couple of questions, one from a client and another from a good advisor friend of the firm here. So the first question is, my question is, what is going away in 2026? You mentioned something was going away, and if you can comment or repeat that, it'd be appreciated.
Oh, thank you for that question. So the entire tax regime that occurred after 2010 with the increased exemption amounts for estate and gift tax that started after the elimination of the estate tax in 2010, and then started back on a progression that ended where we are now with the very, very big $11.7 million exemptions per person for estate and gift tax that is indexed for inflation. In 2026, January 1st, 2026, that is slated to go away. So that is to sunset in January 1st, 2026 and be cut in half, regardless of all the information we're talking about today. That large, or what we might call a temporary exemption amount now, that is going to be cut in half to 5.5 million, to make it simple, and that's going to be per person. So even if none of the proposals on the table cut the exemption now, it is slated to sunset at that time to half of what it is now.
Okay, very good. Thank you. Next question is the $1 million proposed capital gain exclusion? I apologize, I just lost the question. Bear with me one second. Is the $1 million proposed capital gain exclusion on the value of the assets, or is it an actual exclusion on capital gains, i.e. if I can find the rest of it, if your basis is $1 million and your portfolio is now $2 million, you would not owe any capital gains tax on that scenario?
Yes, that is my understanding. And again, I have not looked at every single thing that's being proposed, but my understanding from all of our sources and the summaries I've read and the acts themselves seem to indicate that is what is being proposed.
Okay, very good. And I believe those are all of our questions for now. And again, if you do have questions, please go ahead and post them and we will go ahead and get them addressed. Thank you.
Thank you. And for any questions of a more technical nature after today, if you have those questions, please email me or Jeff, and we will follow up with you if we can't answer certain technical questions today about these acts. All right, so far, what I'm hoping that you've gathered so far is something is about to happen. And we think, of course, with the Democratic majority, with the vice president being the tiebreaker vote, we think it's very likely that something's going to happen. So it's best to be aware, and we're going to talk about what to do next. But let's talk about the advisory team here. The financial advisor, the insurance professional, the certified public accountant, the attorneys. This is the planning team, we could call it, the advisory team. And so we want to collaborate. Clients should collaborate with their financial advisors, collaborate with their insurance professionals. Why am I mentioning insurance professionals? Well, insurance professionals are very important, as you know. And what if we have serious decreases in the exemption amounts? A lot of wealth has been created, as you well know, much more than I do, many of you, and over the last 10 or 15 years. And what are people going to do to avoid these potentially increased estate taxes? Well, insurance professionals may play even more of a key role. Collaboration with CPAs, okay? So look at these recent events, and this is not an exclusive list. The Secure Act, the augmented estate in Maryland, which has to do with marital protection and Medicaid planning. And now look at these estate gift and income tax proposals. And today we've looked at just a little bit of these proposals so far: the 99.5% Act, the Van Hollen Step Act, and the American Families Plan. How could it be that the advisory team is just as important, or not more important, than it ever has been? And that's why I would say the secret weapon for clients is going to be to work with the advisory team, and to work with a team that actually works. And we want to talk about that as well. So what is the advisory team? Well, we just talked about that. It's really us, the people on this call, the client who needs assistance with their financial advisor, their CPA, their attorney, and many times an insurance professional. That is the team. So what are we doing as a team? Well, we should be eliminating the randomness that occurs and the lack of process. We need to be intentional. And I know many of you have heard us say this before, heard me say this before, and you've experienced it yourself. We all can have the best of intentions to be the advisory team that actually works, but we need to work hard to figure out how to make the advisory team effective for the client. So the client, remember, many times is focused on estate planning documents and the process of implementing those documents, but they're not thinking about many of the other issues that the team collaboratively needs to be able to address. So there has to be a commitment on the part of the client to engage, of course, and there has to be a commitment on the part of the advisors to engage, and not only to engage with the client, but to engage together. And I think that is the challenge. So we want to advise before, during, and after the estate planning process. Our particular firm has a client care program that Jeff had mentioned, and that provides continuous updating, education for clients, and staying abreast of the changes, of course. And many of you meet very frequently with your clients, and I know you do a wonderful job with that. So the advisory team, not only having one, so we need to help clients have one, we need to identify the members of that team, and we need the team members to meet and discuss how can we best serve clients. This is the challenge. And if any of you have comments about this after the presentation, I would appreciate your emails, your thoughts on that issue, because this is not something that should just be a theory. This should be something that we actually can implement for the benefit of clients in a very effective way. What is maintenance and updating? Just taking you down a practical road here for just a second. It encourages clients on our side, on the legal side, to participate in long-term planning. It ensures their attention and awareness to changes in the laws, such as the ones we're talking about right now, the potential changes in the laws, changes in circumstances, changes in family and career. It structures on our side annual and biannual reviews, okay? Many of you financial advisors are very used to reviews. Most people in the legal world, most attorneys do not engage in this type of review. So we are encouraging clients here to do that. We believe in that. We encourage the participation of all members, including all family members, fiduciaries, agents, and the financial advisors, and participation of all the members of the planning team. So this ensures continuity. We have a client event every year that even if someone does not belong to our client care program, they're at least coming to one major event per year and hearing about changes in the laws and so forth. So we try to make this viable. We try to make this doable for people. And of course, this is not for everyone, but this is for the person who wants to keep their plan updated. Those are the people that we can help, and those are the people who need the financial advisory and CPA and advisory team. All right, Jeff, I'm just going to check my time here. Looks like we're on time. I now want to talk about understanding the risks and what clients need to know. So far, what do we know that's actually going to happen? Well, not much, but we do know something is very likely to happen. So this first bullet point is major tax law changes are very likely to occur by the fall of 2021. Who knows what it will be? Who knows when? But we have to be aware. Some new laws will likely be retroactive to the date of introduction. So let's talk about that. Some of the laws, income tax related or estate tax related, could be retroactive to September, October of 2021. We don't know. Now, for those of you who have not heard this, and you may already know this, Congress has the right to make any tax law retroactive, basically. So even estate tax laws could be retroactive back to January 1st, 2021. But at this point, the minds or the movers and shakers in the tax world don't necessarily think that's going to happen. The retroactivity would not happen back to January 1st, but there could be a retroactive date to the time of introduction. Let's say something was introduced in the fall, it wasn't passed till later, it could be retroactive back to the fall. Other tax laws will not be retroactive and will become effective January 1st, 2022, according to what is being proposed. So clients need to be informed and educated in advance, and that's what we're trying to do in our newsletter. That's what we're trying to do with our webinars, and I'm sure you're going to do that as well, and maybe already doing that. So a side question, will there be liability for advisors and attorneys who fail to adequately inform and educate clients? Right now in our practice, we're taking some best practice recommendations from some other attorneys that we see as resources in other states, and we are trying to make sure that on our billing statements and in all of our client communications that we're letting people know of these potential changes in the laws. Clients need to be prepared to take action quickly, and this is sometimes not possible, and in many instances it is possible. So I want you to know that my experience has been that where there is a will, there's a way, and hopefully we're not going to get to the fall and then have to rush, but many people will not take action until later this year. So I just want you to know, if you didn't already know, it is possible for clients to take action quickly and to implement planning fairly quickly, although we can't bank on that. Sometimes there might have to be appraisals. Let's say we're doing valuation discounting, or there have to be gifts, there have to be documents drafted. We're going to talk about using out-of-state jurisdictions sometimes to do this planning. So we don't want to wait till the last minute, but we need to be prepared. And if it is last minute, I know we would, and I know most of our colleagues in the estate planning world will make every effort possible to do last minute planning if necessary. So what do clients need to know? Again, we want to review all existing estate planning documents. We want to look at the existing planning strategies or planning strategies that would have been recommended or were recommended in months past, but were never implemented. Capital gains issues should be reviewed, and capital gains planning should be expedited. So we need to think about that because that seems to be the most serious and prolific issue on the table. Exemption planning, the use of the big estate tax exemption should be reviewed, and that planning should be expedited, subject to the caveat that it looks like right now the American Families Plan would put that on hold, but we don't know whether that's just a temporary lull. Planning techniques available in other jurisdictions should be considered. So let's talk about this for just a second. We make it our business here at Elville and Associates to have working relationships with attorneys in other jurisdictions. We know, for example, that all of this type of planning that we're talking about today could be done in Maryland. But we also know that in many jurisdictions, such as Delaware, Nevada, Alaska, South Dakota, and about 15 other jurisdictions, 14 or 15, we know that some of those jurisdictions, for example, our neighbors in Delaware, many times have more favorable laws, and our clients, to be best served, could do planning in that jurisdiction and utilize the advantages, let's say, of Delaware law. So what we're talking about here is not necessarily just Maryland law, but some of the more advanced planning states, such as Delaware, where more options are available to clients, more flexibility is available to clients, especially married couples. Potentially more asset protection is available to clients in these jurisdictions. And those things, in my view, should be on the table. We probably have several proposals right now for clients that are looking at, well, should I do this kind of planning in Maryland? Should I do it in another more favorable jurisdiction? And again, asset protection, flexibility, especially for married couples, is, and sometimes privacy and other advantages, and the ability to add beneficiaries and use special fiduciaries. All of these types of arrangements seem to be much more advantageous in certain states. So we just want to be aware of that as we think about what is best for clients and what should we do now. So what should we do now, thinking about this? We know we have options. We know we have a lot of ambiguity. We know that over the next several weeks and months, the ambiguity will now become much more clear. So my recommendation is to discuss the possible legislative impacts with clients as soon as possible. Let them know what is happening, and you will be on the high road to not only outshine your competitors, but really be a best practice, because we know with reasonable certainty that certain changes will occur. Many of you have advanced planning tools. You have the ability to project values. So I would highly recommend that you look at the projection of estate values, asset values. What is this estate likely to look like in the future? Project those values based on the ages of your clients, and that we look at that together and say, okay, assuming a worst case scenario that these laws are going to be implemented, or unfavorable laws, I should say, would be implemented starting as soon as the fall of 2021, or at least by January 1st, 2022, should we, based on these projected estate values, use our temporary exemption amounts, even if there's uncertainty about whether it really will be reduced or not? Should we do certain things that if we do them in 2022, we are going to be sorry because of loss of step up in basis, increased capital gains rates, and so forth? We need to plan along those lines. We need to plan for no step up in basis. We know that that is a flashing red light. That is the one thing that seems to be consistent with the Sanders proposal, the Van Hollen proposal, and now the American Families Plan. This one is a flashing red light that seems to have traction. We need to be aware of that. We need to review all income tax planning options, especially for high income earners, okay? And as I mentioned in the prior slide, we need to review all estate planning options on the table, proposed or to be proposed. We need to accelerate the implementation of grantor trusts. Remember Senator Sanders' proposal, and I believe also in the American Families Plan, which we didn't get into today into great depth. We know that grantor trusts are going to be attacked, so we need to implement those in 2021 with the caveat of having certain protections in case of retroactivity. We need to implement certain trusts in 2021. Make taxable gifts and use exemption amounts prior to January 1st. And again, you'll see here my caveat, we need to be aware of and plan for potential retroactivity. Let's say we have a client who's very amenable to our advice, very amenable to getting involved in our strategies and our recommendations. They may even be amenable to using the advantages of Delaware, for example, as we strongly recommend some clients do. And let's say they're very enthusiastic and they make large gifts in 2021. But now let's say there's retroactivity that occurs unbeknownst to us that we had no idea this could potentially happen except in theory, and it actually happens. And it triggers a tax because this person thought they had $11.7 million of exemption, but they really didn't. Those kinds of gifts and those kinds of planning have to be tempered with the potential for retroactivity, where there are protections built into those plans, where there can be disclaimers, or the gifts are made by formula, okay? And those are two types of strategies that are used that gift could be undone and the client is not left hanging out there to dry, paying 40% gift tax on something they had no idea could possibly be taxed. So we want to be aggressive, we want to be informative, we want to be collaborative, but we also want to protect against the possibility of retroactivity. We want to fund irrevocable life insurance trusts now to the greatest extent that we could or should prior to 2022, because we know that if these proposals in any form of the Sanders Act were to be implemented, it would severely impact the funding of life insurance trusts and grantor trusts in general after 2022. So that's a consideration. We want to pay estate tax for contemplated gifts prior to 2022. So some clients are willing to make gifts. I had a client the other day who emailed me and wanted to know if he could make a gift to a child of a very large asset. And I had to remind him that he had already used his entire exemption, he and his wife, and that any such gift would be taxable. So he's still thinking about that. So some people, as you know, will make gifts even if they've used all of their exemption amount. It might be worth it for them to do that, and they might go ahead and pay, I should say, gift tax. I should say pay a gift tax, not estate tax, I apologize, for that particular gift. Now, there are ways of getting around that, and anyone you know who's contemplating a large gift that could trigger gift tax in 2021, we should actually discuss that, because there may be ways to accomplish the avoidance of gift tax. But my point is, anyone who could potentially need to pay or want to pay gift tax in 2021, they should potentially do that prior to any increase in the gift tax rates. We need to understand portability and the deceased spouse's unused exemption amount. There's certain ordering of how that deceased spouse's exemption amount is used. We want to understand that. Let's say we have people who have just lost a spouse. Let's say we have a client who has just lost a spouse and they were sitting on the fence about whether they should elect portability. To me, that is a no-brainer, with the potential for the estate tax exemptions coming down, even though they may or may not. That person would be well advised to elect portability. Similarly, we want to harvest gains in 2021 before the increase in tax rates. So if we have clients that are contemplating the sale of assets that are going to incur capital gain, let's get those clients involved in the sales before 2022 when the capital gains rates are slated to increase. We also want to consider harvesting losses, and we won't get into that too much. Anyone you're dealing with who wants to accelerate a grantor retained annuity trust should do so, because we think that GRATs, we think that those tools will be severely limited after 2022. Again, we mentioned this earlier, accelerate valuation discount planning to capture discounts well before 2022 or maybe even the fall of 2021. Again, we talked about this earlier, minimizing risks in case no changes become effective. Okay, so we talked about what if changes become retroactive, but what if no changes become effective at all? And we've done this planning. We need to make sure that the planning is still appropriate for the client and that the client understands, well, I'm doing this and there may not be any change at all. So we need to kind of keep that in mind. It's a very, very ambiguous time. Be aware, again, as I mentioned, that the Van Hollen Step Act is slated to be retroactive. So remember, that is slated to be retroactive to January 1st, 2021. Again, we talked about this a few minutes ago, disclaimers and clients' understanding of the use of disclaimers. This is important. Remember that the disclaimer is a tax election that causes assets that would have been received by someone to be disclaimed and go elsewhere. So we need to have clients educated about these things, the risks, the rewards, the potential for retroactivity, the protections against retroactivity, all of these things. It's a tall order. And we want to use advanced marital trust planning potentially because there's no capital gain under the STEP Act. There's no capital gain for gifts to a marital trust or the use of a marital trust. This is, of course, planning between spouses. Now, I have gone now almost a little bit more than an hour. We're about 5 minutes ahead of time. So I'm going to give you my final thoughts subject to questions and answers at the end. And I hope so far that what you're going to take away from this are some substantive pieces of practical steps informing clients, having a broad overview or a broad understanding of what potentially could happen as you go through your mental checklist of your clients that could be affected by these changes. And I think one of the scary things is these changes could affect lots of clients, not just our wealthiest clients. They could affect a lot of clients with mid-level levels of wealth, so to speak. So what are my final thoughts? Congressional committees are beginning their meetings and analysis now. So this is my understanding from the New York Times, from summaries from our estate planning and estate and gift tax resources, income tax resources and vendors. No one really knows what will happen. We are dealing to some degree with the unknown, but here's what we do know. And this goes back to the gentleman's very nice question about a half hour ago. The current temporary exemptions will be going away January 1st, 2026. The estate tax exemptions will be cut in half to 5.5 million. We know that our country has gone through a recent period of civil unrest and change, very uncomfortable, very sad, very tumultuous. COVID-19 and the massive stimulus. We know we've been dealing with all of this. We know that the Democrats need only 51 votes for tax law changes to occur and for President Biden's agenda to be implemented. Retroactivity, we know that is possible under the tax laws. We also know that the midterm elections are a factor. Now, how do we factor all that in? I don't know, but it is something for us to keep in mind. And we know that no reasonable person would plan for change not to occur. So in other words, a reasonable person would believe that there is a possibility, a strong likelihood that change will occur. So those are the things that we do know. And with that, I hope that that was not too mind-numbing, and I hope that you're able to take away some substantive ideas and steps, at least to inform clients, now having informed yourself of these potentialities and all of the rewards and risks And again, my goal here today is to provide an overview and to give you some practical steps that you can take away, like I have from my preparation of this presentation and my review of all this information, for the highest and best benefit of clients, the advisory team, and again, best practices for all of us. Jeff, with that, I'm going to turn it over to you and see if there are any questions and answers and let you wrap up.
Well, thank you so much, Steve, for a wonderful presentation. I know we all appreciate your time and effort and always your great insight. So we do have a couple of questions at this point, and I'll go ahead and pose them right now. First question is, how can a Maryland resident utilize another state's rules for asset planning?
Thank you very much for that question. So what I'm taking away from what you mean there is how, I'm going to rephrase your question if that's okay, until I hope I'm talking about apples and apples with you. What I think you're saying is how can a Maryland resident utilize the laws of another state to do estate planning and income tax planning and so forth? Well, if that's your question, the world of estate planning today is very fluid. So certain states have very advanced estate tax planning laws and very advanced trust laws. So there are about 16 or 18 asset protection jurisdictions. So I'm talking about asset protection now, but what I'm really talking about is advanced planning jurisdictions. And those include some of the ones I mentioned. I'll just mention a few again: Delaware, Nevada, Alaska, South Dakota, Wyoming, to name a few. And these are states where we could establish either a self-settled trust, it's called, for asset protection, or other trusts that are hybrid asset protection trusts, or something called a special power of appointment trust, and there are many acronyms. We can establish a trust in those jurisdictions, and we can take advantage of those jurisdictions as long as we have a trustee in that jurisdiction. So you could have an individual person, like an independent person that lives in that jurisdiction, that could serve as a trustee, or most of the time we would use a corporate trustee. So for example, in Delaware, there are many, many Delaware trust companies, and they are ready and willing and also there are Delaware registered agents that are willing to serve as agents for LLCs, and there are trustees that are willing to serve, and it's not inexpensive. We find that it costs about $5,000 per year for a Delaware trustee to serve. In Nevada, for example, and Nevada will argue that their trust laws are just as advantageous, if not more, than Delaware. And what I hope you're taking away from that is you see these jurisdictions are in competition with one another. For example, South Dakota has more assets under management than any asset protection state. My last number that I was given was that South Dakota has over $10 trillion in assets under management. So as far as asset protection jurisdiction. But back to Delaware, we normally have a Delaware trustee serve in that example, or a Nevada trustee, which might be willing to serve for about half the cost of a Delaware trustee. But my point is, because you have established jurisdiction in that state with the trustee and all of the connections that they will have and create for you as part of that trust, you can take advantage of that jurisdiction and its advantageous rules and all of the laws of that jurisdiction that provide greater flexibility, perhaps than Maryland, much greater. Greater asset protection. For example, in Delaware, there is something called charging order protection, where your protection, if you have a multi-member LLC, your protection in that LLC is much greater than theoretically it would be in a Maryland LLC. So Delaware LLCs, for example, Delaware trusts, for example, you can establish that even if you're a Maryland resident, and you can take advantage of the laws of another jurisdiction, although it's not inexpensive to do that.
Thank you, Steve. And one more question. If your home is your greatest asset, with a potential large capital gain, especially if there is a loss of a stepped-up basis when one spouse dies and has elected portability. What happens when the surviving spouse dies and the trust beneficiaries sell the asset?
Well, that's a great question. So I'm going to bifurcate my answer real quick by just saying that the portability election, of course, is going to give you the umbrella. The survivor of you is going to provide the umbrella of the deceased spouse's exemption amount, whatever that is at the time of the deceased spouse's death, if they have not used it, plus the exemption amount that you have if you're the survivor at your death. So that's going to give you an umbrella of exemption over the entire estate for estate tax purposes. So hopefully I'm answering your question at least with regard to one aspect of it, which is that portability election has to do with estate tax mainly. Now, with regard to capital gains tax, hopefully what we're going to see is the proliferation of a $500,000 exclusion from tax on the primary residence. And I don't have the answer to what would be the additional amount that would be excluded at the time of the survivor's death. So let's say you have a very expensive or high value residence, and $500,000 of exclusion is not going to cover everything. I think what we're going to have to wait and see is whether the proposed Family Plan Act is going to provide another 1 million or 2.5 million, according to the most recent proposal, for couples. And my assumption is maybe the additional capital gain would be exempted because of that, depending on the value of the residence and how truly valuable it is, or whether that will not be extended to primary residences and the primary residence would be limited to 500,000. So I just don't have the answer on that, but hopefully that $2.5 million per couple, or at least $1 million per person, would be a supplement or addition to the $500,000 of exclusion on capital gain for the primary residence. I just don't know. That's a great question, though, and I thank you for it.
So those are all the questions for right now. So if you have a final burning question, now is your time, as I go ahead and offer a couple of closing comments. So again, thank you to Steve for everything today. Always appreciate your great presentations, and we appreciate you, our clients and advisors, for having a great partnership with us as advisors, and to our clients, we value a relationship with the firm very much. And to both parties, let us know how we can be a resource to you. To our clients, if you'd like to review planning, let us know. We can certainly get you in here to see Steve with all the changes abreast, and certainly get you in here to see Steve and talk about a best path forward. And to our advisors, let's have a conversation how we can work together to best serve clients. Steve and I just had a wonderful conversation this morning with a couple of advisors we've known for many years, but a lot has changed, both here at the firm and also with their practice. It was really great to talk and learn about all those changes and understand them and create a path forward, for all of us, for our clients' best interests. And so let us know how we can do that for you as the advisory team on your end, and we'd love to sit down and talk about how we can be resources to each other. So last thing, our Elville webinar series. We have a number of new webinars coming up. I just want to mention briefly, May 18th, all about D4A Special Needs Trust. That's a new topic that we have coming up. May 20th, estate planning for the surviving spouse, considerations, recommendations, and procedures. May 26th, the Secure Act, 1 year later. How will it impact your estate planning and retirement? And next, our advisors forum in a couple of months. That is Wednesday, July 21st at 12:30. So mark your calendars, and I'll be sure to get invitations out about a month in advance. And so I'll be sure to send the video out to you for today's webinar by tomorrow, if not this afternoon, if I can get it processed. And I think that's everything you need to know about today. And let's see if we have another question here. We do have another question, yes. So thank you for that from one of our advisors. So what planning ideas, Steve, would you recommend to prepare for the loss in step up?
Well, that is a great question, and I think it's a combination of determining, where is the client in this particular situation? Are they a person contemplating the sale of their business? Are they, what kind of family situation do they have? How are their assets constituted? Do they have mostly retirement plan assets and very few non-retirement assets? I think it's specific to the factual situation. For example, are they married? And can we and should we implement a marital trust either during life or at death? Because it looks like those marital trusts and transfers into those marital trusts are going to be exempt. So I think it's going to be fact specific, and I think there's going to be a handful of strategies, to either avoid the higher capital gains tax or to avoid the loss of the step up in basis altogether by using certain strategies that are going to be exempt. And so some of these things would be implemented in 2021. Some of them would be, well, I'm not going to implement them in 2021, but at death, I'm going to implement certain things, and those things seem to be exempt. So I think it's going to be an analysis based on the facts, and there will be, my guess is there's going to be anywhere from 4 to 5 to 5 to 7 different strategies to deal with whatever the final laws and regulations are.
And one more question, a little bit of a specific one, but I'll go ahead and run this by you. So I'm currently using a home equity line of credit to pay for a renovation to keep the tax rate down. Giving proposed capital gain changes, is that something I should reconsider?
That is a question I would have to ponder a little bit. So if you wouldn't mind, if you could shoot me an email, I would, and kind of give me an idea of what the interest rate is, what the mortgage balance is, and maybe just a ballpark idea of what your assets are. I might be able to answer that a little bit more. I'm not sure that there's really anything that whether you do that or not do that is going to affect anything, but I don't have enough information to really answer that question, so I apologize. But please feel free to shoot me a question by email. Steve@elvilleassociates.com.
Yes, and that final slide that Steve can move to does have his email,
Jeff,
which is, yes, Steve@elvilleassociates.com. And also my email with any non-legal questions, as I'm not an attorney, Jeff, J-E-F like Frank, F like Frank, @elvilleassociates.com. Always to help you, happy to help you with anything that you might need, or with any questions, I can always get them over to Steve. So we want to thank you again for your support of the Advisors Forum and the Elville webinar series, and for your relationships with Elville and Associates. And we look forward to seeing you on another webinar again soon. So have a wonderful day, everybody, and we'll see you again soon. Have a great day.
Thank you, everyone. Be well.